Hi, this is Richard Chamberlain, and welcome back to the Protecting Your Family's Future podcast. Today, we're going to be talking about using a donor advised fund to maximize your tax deductions while continuing to make charitable gifts. Now, a couple of weeks ago, we talked about end of the year gifting strategies and things that people can do in making year end gifts. One of the things that I talked about was using a donor advised fund. That's a pretty complicated topic, and I felt like it deserved more detailed treatment. So we're going to talk fully about it today. So the idea is you want to give gifts to charity, and you would like to do so in a way that is tax efficient. You want to maximize your tax deductions, minimize your income tax. So here's how that works. Now, before we go into that, let's talk generally about what a donor advised fund is. We mentioned it briefly a couple of weeks ago, but it is a fund that you create either through a community organization or a financial institution. It is a charitable account, if you will. In the account, when you make gifts to it, you get a tax deduction for the gifts that you make into that account. Now, you can't get that money back. That is a gift that you have given. Now, you've given it to this fund, and from the fund, you then direct gifts to individual charities in the timing and in the amounts that you want. So when you put money into this donor advised fund, you get a tax deduction for the gift that you make into that fund. You get a full tax deduction for the amount that you put into that fund, and then you direct that distributions are made from that to the charities that you want to give to. And you can do that over time. It doesn't have to be right away. You can do it each month, or, in whatever intervals you want, or you can make one-time gifts. It's entirely up to you, because you are advising, you're the donor, and you're advising the fund where to make those charitable gifts. So how does that work with maximizing income tax deductions? So years ago, the standard deduction was increased for the filing of individual income taxes. The standard deduction is now $13,850 for a single person, or $27,700 for a couple filing jointly. So if you don't have deductions of amounts more than that, you don't itemize your deductions anymore. You take the standard deduction because you get more of a deduction, and that lowers your taxes. So let's say, for example, you have a home and you deduct your mortgage interest, you deduct your state and local income taxes, and those deductions come up to $10,000 per year. As a couple, you're filing jointly, so you've got the standard deduction of $27,700 for this year. You also make charitable gifts of about $15,000 per year. So combined, if you take your mortgage interest, state and local income taxes, and your charitable gifts, you've got $25,000 in deductions. The standard deduction is more, so you would take that. You would not itemize. But if you instead used a donor advised fund, maybe instead of giving $15,000 to your charities, you contribute $30,000 to the donor advised fund this year. So you get a $30,000 income tax deduction for that distribution into the donor advised fund. You still get the deduction for the mortgage interest and state and local income taxes that you paid. So combined, you have a $40,000 itemized deduction, which of course is more than the $27,700 standard deduction. So you can itemize in that year And then throughout the next year, you can have that donor advised fund continue to make your weekly, monthly, quarterly, whatever distributions should be made from that donor advised fund to your charities. And that can happen throughout 2024 and even into 2025. So you've taken 2 years worth of gifts and made them all in 1 year to the donor advised fund, and then from the donor advised fund over the next 2 years to your charities. So they're not impacted by the change in timing of your contributions. Now, the next year, in 2024, let's say you make this gift in 2023. In 2024, you're not making deductible charitable gifts because you already got the deduction for the distribution, for the contribution into the donor advised fund. So you're not making itemized deductible charitable gifts. So in that next year, you are going to instead have the standard deduction. You'll still have your mortgage interest and your state and local tax deduction, but that's not going to total up to more than the standard deduction. So you'll just take the standard. And then the next year, you can make another contribution into the donor advised fund, double up those gifts again, take the itemized deductions, which is going to lower the income taxes, and then continue to make the distributions out of that donor advised fund to your charities. And it just continues on. So it's kind of a 1 year on, 1 year off sort of a thing. By combining those charitable gifts, by accelerating them into 1 year, you're able to increase the amount of the charitable tax deduction, which allows you to itemize, to have more than the standard deduction. So I know that's kind of complicated, a lot of math there. You'll definitely want to consult with your tax advisor and your financial advisor as to whether this is a viable plan for you. Certainly get personal tax advice and financial advice before doing anything like this. But I hope that information is helpful for you and it gives you some ideas of things that you can do to minimize your income taxes. So if you have questions about this and you want more details, feel free to reach out to us. And I hope that's helpful for you. And we'll see you again next week. Thanks.